Good morning. I'm Jenny Rae LaRue. We are excited to be with you today. It is Monday, May 19th. And Namaan, welcome to Market Outsiders this morning. How you feeling on a Monday morning?
We are jumping right into the week. I often think that, hey, Monday morning's a chance to ease into the week, but the headlines seem to hit hard and heavy on a Monday morning. I'm excited to dive in.
I'll tell you what, waking up on the West Coast, we always feel like we're a little bit behind, like ahead in life, but behind the markets, you know? So I'm excited to dive into. You want to kick us off? What do you think is, I think there's one big headline today. Should we ignore it or should we go straight for it? What do you think? Mhm.
Well, I'm curious to hear if you think that the big headline is what I think the big headline is. So to me, the big headline is that US Treasury yields this morning touched 5%. And so I don't actually think you're going to see a lot of this in the mainstream media in terms of, coverage. And really what this means for the uninitiated, Treasury yields are the interest that the US government pays to entice people to buy government debt. And really, they are the benchmark by which every other asset class is measured because US government debt is considered risk-free. And so if US Treasury yields touch 5%, then what that means to the market is that you have a 5% return that is almost guaranteed to you. It's risk-free because there's a 99.9% chance that the US government isn't going to default on its obligations. And so every other asset class now is affected by this benchmark. Because if I can get 5% risk free, then I demand a premium for taking risk. That's true if I'm taking risk in the stock market. It's true if I'm taking risk in the bond market. It's true if I'm taking risk in real estate, in crypto. It doesn't matter what the asset class is. The benchmark has risen. And so now the returns that are being generated by every other asset class also have to rise for me to not just default to taking a position in US Treasuries and generating a 5% risk-free return. And so I think that this is bad news for the markets because there's you could see a flight of capital. You could see capital leaving equities. You could see capital leaving other bonds and moving to US Treasuries. And it's bad news for the US government because it means that the share of our budget that's taken up by interest payments is going to rise. And so the yield touched 5% today. It's back down below 5% as of this recording. But to me, I think 5% is a number that means a lot mentally to the market. As if it's in the fours, okay, that seems normal. But once that number starts with a
We can beat
five,
a 4.8, right? Yeah.
exactly. All of a sudden, I think you're going to start to see this flight of capital. So that's the number I'm paying most attention to today, and I don't know if it's getting the attention it deserves.
I love it. Well, I think that what's interesting about that number is I'll kind of highlight it with a story. I have a friend whose dad sold a company about 20 years ago. And we were talking about investing recently, and he said my dad has two asset classes, T-bills and like really risky projects in Vietnam, and that it was kind of this like visual picture of exactly what you're talking about because his dad holds seven figures of basically what he feels like are cash in US Treasuries. And I grew up in the era of CDs. I don't know if you ever got a CD from like an aunt or a grandparent, but in the era of CDs when you would walk into a bank and they would be like, "Look, we will hold your money for 6 months and we will give you 1.9%." And I felt like the king and queen of the world with my siblings walking out of that bank getting 1.9% on my money. And really like T-bills are the CDs of today with even more liquidity. What is it, one day to sell out of T-bills and back into the market? Like there isn't even any reason to hold money in cash anymore if you can hold something in T-bills. And so yeah, when T-bills hit these yields, then yeah, it starts to squeeze out these other asset classes. So basically what he was saying is like a medium amount of risk doesn't even make sense for me
Yeah.
anymore. Right? Because it's not large enough to change my life and I can just keep clicking along with some interest on my cash. And I felt like that was really a fascinating way for me to personalize the way that even institutions are thinking about some of their asset decisions. Naman, I was going to go straight for the Moody's news though, because I do feel like the two are tied together. So, I don't know if you were deflecting on purpose or if there was some specific reason why you didn't lead with the Moody's news. But I do think, by the way, that the Moody's news is less important than the markets will take it, but I do think it signifies maybe a shift in sentiment that is very important. So, do you want to kind of lead off with, do you have a headline? I can pull one up if you don't have one yet.
Well, the headline is that Moody's is the last of the three major rating agencies that just dropped the US's kind of debt rating from AAA to whatever the level is below AAA. And I think that's one of the reasons that the Treasury yield touched 5% this morning, is because now the last of the credit rating agencies is saying that US government debt is a little bit riskier than it was last week. And so when there's more risk involved, you expect a higher yield. And so you're right, the two are interrelated. And I think that there's a cause and effect here, at least a little bit. Cause, Moody's downgrades the US government. Effect, US Treasury yields rise.
Absolutely. So let me just pull up a specific article here. Right. Right. Moody strips U.S. government of top credit rating. Well, that sounds, I think, a little bit harsher than it is. But I also think that we need to kind of harken back to 2008 when the world learned about how these credit ratings are done, and how subjective they can be. I think that's kind of important in this particular situation. Right. Sightings. But what I think is the important thing here is the second part of the headline, which not a lot of people are going to talk about, which is Washington's failure to rein in debt. Which is very, very different than what I think a lot of people are extrapolating from this, which is a sign of strength in the U.S. economy at large. The two are interplaying, but not. This is not saying the U.S. is in a recession, right? Can you just talk about how people might get that wrong and how we should think about that correctly? What's the difference between the debt impact of this and the actual credit rating that we're talking about here? Because we're going to see markets respond to this. It's going to look like a response to the economy, but what does it really mean? I think you started, Namaan, but let's go a little bit deeper on that.
Yeah, absolutely. This has nothing to do with the economy at all. It has everything to do with the long-term fiscal outlook of this country. And so you're right. I think this is a bigger headline than it is like an actual like driver of any kind of market or economic activity, because when you look at assets around the world, US treasuries are still seen as risk-free. Like there's no other place, if you're looking for safe returns, that you'd rather park your money than the US treasuries. So some of this is kind of news that wastes newsprint, if you will, because it doesn't actually change behavior. But I think the message that Moody's and the other credit rating agencies are sending is important, and that is that we are on an unsustainable fiscal path, right? U.S. debt is, what is it now, January? $36 trillion. That number is unfathomable. It's exploded in the last decade, and I think what they're saying is that they're seeing an inability from Congress to actually get serious about fiscal reform. I think what we have gotten used to is the Federal Reserve bailing us out of hairy economic situations. But monetary policy, what the Fed does is only one lever that we have at our disposal. And often what happens is you have Fed actions in direct contrast to fiscal actions, right? That's the money that the government is spending that Congress is allocating. And so instead of working together in concert, what you're seeing is that you have different quasi branches of our government working against each other in some ways, because the Fed's setting monetary policy with one set of goals, Congress is setting fiscal policy with a completely different set of goals, and we're not rowing in the same direction. And I think what Moody's is saying here is that if we don't figure out a way to get our deficits under control, the debt's going to continue to explode. And, there's going to come a time where the entirety of US government spending, is just concentrated in paying interest on the debt, Medicare, and Social Security. There's not going to be room for anything else. And, all you do as a country when you get to that place is you back yourself into a corner. You have less options than to get out. And I think that's a long-term concern, but it's not something that's going to stifle economic growth today.
I absolutely agree. In fact, this when I was looking for something to pull out of a article this morning, I thought this one was the one, right? In a statement, Moody said, just to kind of recap what you just said, right? We expect federal deficits to widen, reaching nearly 9% of the US economy by 2035. So basically, this is based on a model that's 10 years away. right? And so I think that's really important because if you're modeling 10-year numbers, you're looking at 10-year treasuries, you're looking at 10-year numbers. These are different than if you're thinking about the market and the economy, a buy today and a sell in 3 months, right? This is a very long-term outlook, longer than I think most people would actually feel comfortable safely extrapolating. Also up from 6.4% in 2024. So we're already at 6.4%. What this means is that it's going to grow. But what I think is super important here is that you see these increased interest payments on debt. The more debt we have and the higher the interest we have to pay on it, the two of those are contributing factors. Like you mentioned, rising entitlement spending, Medicare, Medicaid, and Social Security. And then finally, relatively low revenue generation. I think this one is super important. In fact, we've seen this in California. It hasn't only been the government's increase in spending, it's been our lack of revenue generation that's been the key. And what's going to result in, revenue generation? I would argue that the piece of missing data that's here is a lack of a release in regulations in the US economy. Because the one thing that could change the balance of this entire equation is growth. You can outgrow some of these expectations and spendings and borrowings, but you have to do something outsized in order to get there.
You
And
beat me to it.
yeah, right. And so like one way to balance a budget, just thinking about a household budget, is to spend less. One way is to make more. The US is not focused on just, amping up the making more part of the economy right now. And I think an unleashing of regulation could actually really change the balance
Yeah.
here. I do think that fiscal responsibility is important, but I think that's not talked about anywhere in this article. And I think it should be more focused on in the news.
100% agree. Do cuts need to be made? Yes. Can you cut your way to a balanced budget? No. You need
Never.
to grow, you need to grow your way to a balanced budget with how big our debt and our deficits are. And when we say grow, we don't mean an increase in taxes. We mean an increase in economic growth.
That's right.
That's
Keep tax
an
levels the
increase.
same or even cut them in order to get to economic growth and your overall tax revenues increase, right?
You want a
Um,
broader base.
that's exactly right. Yeah, more foreign investment, more economic growth, higher salaries, right? Bigger company sales. Like these are the things that are going to make a big difference. And the US has to remain the place in the world to invest in those things. And I see a concerning trend of creeping regulation along with creeping entitlement spending that doesn't balance out some of these rising costs. And I think there is a way that we could really unleash the US economy that we haven't pursued yet. Is there anything more to say?
There's a ton more to say, but we'll save it for another day.
Awesome. So yeah, if you're looking at the news this morning, the my favorite things are questions about buy the dip, sell the dip. Our general sense is like stay the course. But if you are borrowing, if you're in a business that has borrowing costs, like pay attention, your borrowing costs are going to increase. If you're in a business that needs to think about how they're going to, impact what happens here, I think the focus has got to be on revenue generation, right? How in a market like this do you improve revenues? Will you have to tighten your belt in a time of rising borrowing costs? You might. But you definitely need to focus on growth. And I think top line growth will remain super important. So we'll be back tomorrow talking more about what's happening in the news. Depending on what happens today, we'll see more out there tomorrow. As always, our inboxes are open for your questions. In addition, we will see you live this Thursday. We're going to do a live extended session. We have no idea what we're going to talk about because it's not Thursday yet, but it's going to be great. We're going to take your questions live. We're going to have you on the call so that you're able to join us and chime in yourself. We're really looking forward to that. And we will see you this Thursday. Thanks, everybody.